Welcome back to the deep dive. Our mission today is, well, it's to give you a shortcut. We take a huge stack of research economic reports, market analysis, and pull out the crucial bits you need to understand one of Africa's fastest growing markets.
Exactly. And today, we're zeroing in on Zambia. We're looking at what our sources are calling the investment triumvirate.
The triumvirate, I like that.
So the three core ways successful Zambian investors seem to build and protect their wealth.
Yeah.
Government bonds, shares, and real estate.
That's right. And we're going to skip past the really basic definitions today. We're assuming you know the fundamentals. Our job is to tell you how these things actually behave in the Zambian context.
And more importantly, why they matter there. You're constantly up against, well, two big challenges as an investor in Zambia.
High local inflation, for one.
And the volatility of the kwacha. It's a persistent issue.
So every choice has a major trade-off. Our goal is to find those little nuggets of insight that help you match what you want to do. Preserve your cash, get some income, or go for, aggressive growth to the right tool for the job.
Okay, let's unpack this. We should start with the foundation, the defensive play, the one known for stability.
Zambian bonds.
Let's get into it.
And when we talk about Zambian bonds, really 90% of the time we're talking about debt from the government of Zambia, usually issued through the Bank of Zambia.
So these are the anchors of a portfolio.
They really are. And the predictability is the whole appeal. We know bonds are debt, but it's the structure that makes them so attractive.
There's that schedule, right?
It's the scheduled payment and the guaranteed return of your initial money. You lend the government, say, 10,000 kwacha, and you get these fixed periodic interest payments, the coupon, all the way until it matures.
And that stability is just critical when everything else feels a bit uncertain.
It really is. It's a sharp contrast to the stock market.
But I do have to push back a little here because the sources we looked at point to a kind of friction point.
With the high inflation rates you often see in Zambia, is the stability of a bond actually creating wealth? Or is it just sort of preserving some of your capital while inflation quietly eats away at your buying power?
That is the core conflict. You hit on it exactly.
Is the stability more psychological than, financial?
It can be.
Yeah.
I mean, you might get a nominal yield on a 2-year treasury bill that looks great, say 20%. But if inflation is running at 15%...
your real return is only 5%.
Exactly. But, and this is where the local context is everything, the alternative is often worse.
How so?
By locking your money into a government bond, you're taking a huge risk off the table. The risk of a massive kwacha depreciation or a sudden stock market correction wiping out a chunk of your capital.
Ah, I see. So it's less about getting rich.
And more about not getting poor quickly.
Yeah.
It's the safety valve in the system.
That's a crucial distinction. It's a defense mechanism. Let's make this practical. We've got that example of the teacher in Lusaka.
Right. A perfect case. So she puts, say, 10,000 kwacha into a 2-year treasury bond.
Okay.
She gets her interest payments like clockwork, maybe every 6 months. That's steady income. But the real key is the technical difference between treasury bills and treasury bonds.
Okay, break that down for us.
T-bills are short-term, usually under a year. They're very liquid, so you can get your money out fast. Great for short-term cash management.
Got it.
Treasury bonds are the longer-term play, maybe 5, 10 years even. They are less liquid, but they almost always carry a higher interest rate, a higher coupon.
So they give you better protection against that slow, creeping inflation over the long haul.
Precisely. So if you're saving for a down payment on a house in 2 years, you lean towards T-bills, safety and liquidity.
But if you're saving for your kid's university in 8 years, you probably want that long-term treasury bond.
That's it. Bonds are for investors who want low risk, a predictable income stream, and to keep their capital safe. It's the defensive pillar.
Okay, so we've got bonds as the safety net, the anchor. But if you actually want to beat that double-digit inflation, if you want real capital growth, you have to take on some calculated risk.
Which brings us to section 2, the growth engine.
Shares. Traded on the Lusaka Securities Exchange, the LUST.
Yep.
And this is where it gets really interesting. You're trading that guaranteed coupon payment for the much higher potential returns that come from owning a piece of a business.
You're buying into the future success of the Zambian economy.
And what's fascinating is that while the LUST is smaller than some of its neighbors, it's really concentrated. It perfectly reflects the domestic economy.
You've got the heavy hitters. Companies in key sectors like banking, telecoms, beverages.
Often in almost monopolistic positions.
Sometimes, yes. But that concentration, it raises a really important question, doesn't it? We're always talking about diversification.
Always.
But on the Lucier, are you truly diversifying? Or are you just making a bet on the success of maybe 4 or 5 major sectors?
That's a great point. I mean, that's a real structural challenge for a Zambian investor, isn't it? The whole market is heavily weighted towards a few big players.
And many of them are foreign-owned companies that are just listed locally. So while you can spread your money between, say, Airtel Zambia and Zambeef and
But
ZCCM,
at the end of the day, they're all exposed to the same big picture economic factors.
exactly, the same macro factors: global commodity prices, domestic consumer spending.
So if copper prices, the nation's economic engine, take a dive,
It hits everyone. It affects liquidity in the banks, which hits consumer confidence, which hurts Zambeef sales. The whole thing is very tightly correlated.
more so than on a bigger, more diverse exchange like in Johannesburg or London.
Without a doubt. So this requires a more sophisticated approach. Shares absolutely offer higher long-term growth, no question.
Through the share price going up and through dividends.
But that growth comes with high volatility, and
Oh.
that is the trade-off. That's the price of admission for higher potential rewards.
Let's use that specific detail from the source material. If you buy shares in a big bank on the Lucy, you do incredibly well when the economy is booming.
Oh, for sure.
But when things tighten up, that same stock can fall sharply and your capital is directly exposed.
Which is why your holding period for shares has to be much longer than for bonds. You should be thinking 5 years minimum, ideally more like 10.
You need the patience to ride out those cycles.
You do. And you also need the patience to manage the liquidity. Finding a buyer for your shares on a small exchange isn't always instant. You can't just click a button and have cash in your account in a second.
So this really suits the more aggressive investor, someone focused on capital gains, not immediate income, who has spare cash and is willing to do the research.
Yes, they're chasing the kind of growth you need to really crush high inflation over a decade.
All right. Let's pivot to the third member of this triumvirate, the one that I think carries the most cultural and emotional weight in Zambia.
Real estate, the tangible asset.
It's just so popular.
It's more than a financial decision here. It's a deep cultural aspiration. The emotional appeal is massive. It feels secure,
You can see it, you can touch it.
and you can pass it on. It's a physical legacy in a way that, a stock certificate just isn't.
And from a practical side, the appeal is twofold. You get rental income now, and the property value goes up over time.
And our sources highlight the incredible market demand. This is driven by rapid urbanization, especially in the Copperbelt cities and, of course, the capital.
You're talking Lusaka, Ndola, Kitwe, Solwezi. These places are growing fast.
Very fast. And that demand means rental units, especially for the middle tier of the market, find tenants quickly. This gives you a stable, often high-yielding monthly cash flow that has nothing to do with what the Luwesi or the bond market is doing day to day.
Let's use that example we found of the family buying a plot and building. They might find some land in an emerging suburb like Chalala.
Or maybe an older, more established area like Kabwata.
Right, and if they go the Chala route, the land is cheaper, but the infrastructure might still be developing.
But if they build, say, a 2-room rental unit or a small block of them, that rental income starts coming in almost immediately.
And that starts paying back the high initial building costs.
Crucially, yes. And at the same time, the land itself is appreciating as the city grows out towards it. It's a powerful 1-2 punch.
So regular monthly cash flow plus passive growth on the land value.
Absolutely.
Hmm.
But, and this is a big but, this is where we have to talk about the price of that tangibility.
The downsides.
Real estate has the highest barrier to entry of all three. You need way more starting capital than you do to buy some bonds or open a small brokerage account.
And you're not just an investor anymore. You become a manager, a landlord.
Precisely. The hidden costs and the sheer effort involved are huge. Repairs, maintenance, property taxes, the legal side of tenant disputes,
The headache of vacancies and late payments.
all of it. And if you took out a loan to build or buy, you've got that pressure of the interest costs every single month, whether your tenant pays on time or not.
And we can't overstate the illiquidity. A bond might take a day to sell, shares maybe a few days on the Luzase, but selling a house?
Selling a prime property in Lusaka could easily take 6 months, maybe a year. Longer if the market is soft. That cash is locked down tight.
So real estate is for someone with a good amount of starting capital who wants that monthly cash flow and who is ready for hands-on management. It's for the long, long haul.
Absolutely.
Okay, so we've broken them down. The triumvirate: bonds for stability, shares for growth, and real estate for tangible assets and cash flow. Now, let's put it all together. How do you actually use them?
Well, the biggest takeaway from all the data is that in a challenging economy like Zambia's, the smartest investors don't pick one best option.
They don't fall into that trap.
They blend them strategically.
Okay, let's recap their roles in a full portfolio. Bonds are your defense.
They protect your principal, give you predictable income. It's your emergency fund and your near-term savings.
Shares are the offense.
That's your inflation fighter. The best chance for real growth, but only if you can handle the volatility.
And real estate is like the operational hub of the whole thing.
I like that. It generates that reliable, diversified monthly cash flow stream. It's a hedge against other market shocks.
So the practical Zambian strategy often looks something like this. You use government bonds to stabilize everything and to park cash, you'll need in the next couple of years.
Right. But at the same time, you're putting a small portion of your capital into LUSE shares to make sure you've got that long-term growth engine running.
And then the income from the rental property, that steady cash flow, can be used strategically.
Exactly. You could use it to fund your next bond purchase, or you could be more aggressive and use it to, say, dollar cost average into the stock market. You buy more shares when the market dips without having to touch your core savings.
It's all about managing how these things relate to each other. When the stock market is down, your rental income probably isn't.
And when the economy is struggling, your government bonds are still paying their coupons. This blend creates a structure that's genuinely resilient.
So what does this all mean? It means understanding the limits and strengths of each asset lets you plan for different financial goals. You're not just relying on one engine.
You're building three distinct complementary engines.
But as you think about how to blend these three for the long term, it brings up a really interesting final thought for you to consider.
When you're building a portfolio that's meant to last for decades, how do you manage the extreme illiquidity of real estate against the volatility and concentration risk of the stock market, especially when your ultimate goal is having access to your money later in life?
That's a huge challenge. Structuring your assets so your current income doesn't get in the way of your future ability to actually access your capital when you need it.
It's a fundamental question of portfolio design.
A great thought to end on. Thank you for joining us for this deep dive into the investment triumvirate in Zambia.
And just a quick but very crucial reminder before we sign off. The information we've discussed today is for general guidance only. It should not be taken as personalized financial advice.
Every investment carries risk. We strongly encourage you to do your own independent research, your own due diligence, and please consult a qualified financial professional before you make any investment decisions based on what you've heard today.